Hello, everyone. Welcome back to Signal or Noise. This is episode 26. Charlie Bilello here, and with me, as always, Peter Mallouk. Peter, did you follow any of the Woodstock for Capitalists that went on a few weeks ago, the Berkshire annual meeting? So we're going to be digging into some Warren Buffett stuff. Are you a Warren Buffett guy? I've seen you quote him a lot. What do you think about the event there? Have you ever been there?
Never been to it. Huge fan. I do follow it. I'd watch the clips and read a lot of the excerpts from it. And, usually his best nuggets have nothing to do with investing. And I'm always worried it's the last time we're going to hear from him because he's so reasonable. And, the number of reasonable people in the finance space is quickly diluting. We lost John Bogle a long time ago. But a big fan. So this is going to be a fun episode.
Great. Yeah. First meeting without his longtime partner, Charlie Munger. So we're going to dig into 10 lessons from Warren Buffett. Had to narrow it down. I had 20. I was going to probably go 34. We were going to do a 3-hour Rogan type podcast, Peter. But I distilled it down to 10 for today. Number 2, selling fear, which has become an industry, unfortunately, on social media and an industry for financial news and just news in general. So we're going to dig into that, and we'll end, as we always do, with Signal or Noise, talking about Dr. Copper, which is known as the PhD, the medal with the PhD in economics. So we're going to talk about whether copper matters for the stock market and for the economy. Okay, let's start out. 10 lessons from Warren Buffett. Lesson number 1 here is one of my favorite quotes from Buffett: never bet against America. In its brief 232 years of existence, there has been no incubator for unleashing human potential like America. Despite some severe interruptions, our country's economic progress has been breathtaking. Our unwavering conclusion: never bet against America. He wrote this in the 2021 shareholder letter. Peter, I know you have a similar philosophy, but it's not always easy looking at this chart of GDP. See all those gray bars there? Many recessions. There will be more to come. What's the lesson for investors when you start out talking about having that optimistic attitude about America and about the world getting better in the future?
I mean, the chart itself answers the question. When you're going through these recessions, they seem like the end of the world. There are people listening to this that were old enough to go through as an adult the tech bubble and 9/11, and most of the listeners have been through 809, and everyone's been through COVID. And when you're going through it, and it's minute by minute, hour by hour, day by day, month by month, it seems catastrophic. But when you look at it, through the rearview mirror, it seems like, oh my God, why did anybody worry about anything at all? America has a couple of advantages, and one of the advantages people talk about is democracy, capitalism, and people worry that both of those are, kind of converting over time to less democracy and a move towards socialism. But the other thing the United States has is just abundantly rich. I mean, the country is abundantly rich. It's protected by 2 huge oceans. It's got the best river tributary system that exists on Earth. It's got friendly neighbors to the north and south that it never needs to worry about an invasion of any kind. It's got enormous oil reserves, incredible producing timberland, and on and on and on and on. And so you've got the best systems combined with a country that's abundantly rich, and good things happen. You overlay on that what everyone in the world is benefiting from, which is the emergence of the elimination of the poverty, the group of people in poverty, pulling up into lower middle class, and upward from there, and the technological revolution. And it's hard to bet against any of this over the long run.
And so when you're living in one of these crises, and there's been many of these crises, I guess all of that is easier said than done, right? If whether we're talking about 2020 during COVID, literally the first time in history, we literally shut the economy down for a month. We have tech bubble, we have 9/11, we have wars. When you're living in it, Peter, the only thing that I think you can draw on is the fact that the history of America is coming back from these things and coming back oftentimes stronger. And that in spite of all of these bad things, we've seen the S&P 500 since 1930 average 9.7% per year. We've seen GDP, real wage growth increase over this period of time, adjusted for inflation, things getting better, but not every day, not every year. That's the problem. But pretty much every decade and every 20-year period. So you have to really take that longer term view as an investor, as an American, and you have to avoid that, which we're going to talk about later, that negativity bias that we all have.
That's why the intelligent investor wins, right? The intelligent investor looks at this and their lesson is resilience. And the unsophisticated investor, when they go through a crisis, they think, oh my God, you get caught up in the narrative that's on TV and on social media and you panic and you sell. And it's because of this reason that you get that 10% return that you're referencing. If no one was freaking out ever, there would be more money in the space all the time. The return would be much less than it is. And so the intelligent investor not only wins, they win because of people that are not taking the right lesson from this.
Right. No upside without occasional downside is definitely a message. Number two, patience pays. The stock market is a device for transferring money from the impatient to the patient. And we see this, Peter, at extremes really on full display. Look back, March 2020, investors pull a record $326 billion from equities during that month. We know what happened. There was a huge crash, fastest bear market in history, took the S&P 500 down over 30%. And you fast forward, not even 2 years later, the market's doubled, more than doubled from that low, recovered. And many of those investors, the impatient investors that were saying, I need to trade this or I need to get out, I'll get back in when the news is better. They're transferring that. Who's buying? For every seller, there's a buyer. Who's buying? Well, the long-term patient investor who's adding to their 401k, adding to their IRA every single paycheck.
Yeah, same story. There's all kinds of data around the biggest outflows tend to happen at the market bottoms. I find those to be some of the saddest graphs that we ever go through because those sellers are usually the people that are the least likely to be able to withstand the permanent losses that they've locked in. And so it's not just that these patient winners, the people that are buying through the down market win big. Unfortunately, a lot of people that are panicking, they're the ones that really can't afford to lock in those losses.
Yeah, absolutely. And we're seeing that again. I didn't have it in today's slides, but the meme stock craze is back a little bit, and it's all the impatient investors. I can't believe it's back, but maybe we'll talk about that next episode. But I suspect by then it probably will have gone back down
Right.
again. But all of these people thinking that the road to wealth in the stock market is making a quick gain versus that patient investor looking at the long term odds don't have to play that game, right? If you
Right.
have 10, you have 20 years, you look at the huge returns that investors tend to average over those long periods of time, then you wouldn't be looking to make that quick game, which the odds are very much stacked against you. So, number three, the forecasters. Peter, I know this is a subject near and dear to your heart because you've written about it in your books and you talk about it oftentimes. And there will always be forecasters because we love hearing that certainty from a supposed expert about the future. This is a quote from Buffett where he's saying, we've long felt that the only value of stock forecasters is to make fortune tellers look good. So we know Buffett's opinion on that. And perhaps my favorite indicator in terms of this historically was in 1979. You had a terrible decade for equities. They were really beaten down, among the cheapest levels they were in history at very high inflation. Here's the cover of Business Week, The Death of Equities, how inflation is destroying the stock market. And we see this very often where this outlandish type of forecast is made at the exact worst time possible for you to be following this advice. And so, is it just as simple as ignore all forecasts or ignore all forecasts, especially when they're given way after the fact where they're piling on to a move that has already been going on for so long that you're likely to see mean reversion in the opposite direction?
I think anytime you're talking about a forecast that is weeks, months, or even a few years, it should be 100% ignored. That seems extreme, But really, the economy is too dynamic. It's too hard to figure out. Look at the Federal Reserve, supposedly the most sophisticated, right? The leaders of the economy in most ways. They gave an indication of what they thought was going to happen this year, and they were 100% wrong, right? I mean, it's like spectacularly wrong with that prediction. So it's too dynamic. To me, the signal that you're talking to somebody who doesn't know a lot about investing or the economy is if they're giving you a forecast with certainty. It's one thing to give an opinion, right? Here's what I think is going to happen. That's totally fine. But when somebody tells you, this is definitely going to happen, they have a lot of conviction, that is somebody you should just across the board ignore everything they say about everything economic or investment related, because anyone with that kind of certainty doesn't know what they're doing.
So if they're using words like will or must, or
100%,
then
definitely going to
just those
happen.
are red flags, right?
Right,
It's not as interesting when you go on CNBC to
right.
say stocks might be up 20% or down 20%. We want to hear that person say stocks are going to go up this exact amount by this date, but obviously you have to ignore it. Now, 20 years following this, here's the ironic thing that you often see following these types of statements and forecasts is the exact opposite of what they're saying happens, will happen, actually does happen. So what transpired after that death of equities cover famously is the best 20-year return for the stock market in history. It went up 17.4% per year every
Yeah.
year over the next 20 years. And yes, there was a dot-com bubble that helped it out a little bit, but just unbelievable if you took a longer term view. If you took a short term view, probably in the early 1980s, you're probably like, oh, that they were right. That cover was right? We had two recessions in the early 1980s. We had two bear markets, and you were probably saying it was right. But you fast forward over the long run, and this is what you tend to see over time. So this year, Peter, and we've touched on this, but I want to touch on again because just remarkable. This will be the fourth year in a row if this holds, where it's just so extreme, where every strategist, nearly every strategist, has gotten it wrong so far this year. We're at over 5,300 for the S&P 500 here in mid-May, and the average target for the end of the year was at 48.61. So we're 9% above the average target, almost above every single target from Wall Street strategists. And no doubt at the end of this year, these same strategists will be predicting what will happen in 2025. But please, 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 if you're watching this, use this as yet another indicator that they don't know what's going to happen any better than you or I do. And it's foolish 100% to try to follow this and saying, I'm going to buy more stock or I'm going to sell stock because a strategist is predicting where the S&P 500 is going to be.
Yeah, it's always been a game to take what the strategists say at the beginning of the year about the bond and the stock market, compare it at the end of the year, and it's just more validating to the long-term investor exactly what Warren Buffett's quote was, right? That this just makes fortune tellers look good.
100%. Okay. Lesson number 4. Don't wait for the Robins. I often refer to this op-ed because it's people don't remember how bad it was in October 2008 and how difficult it probably was even for Warren Buffett to write something like this. He actually wrote an op-ed in the New York Times saying, I think the title of op-ed was "Buy American, I Am." And he had this famous quote in there, Peter. I haven't the faintest idea as to whether stocks will be higher or lower a month or a year from now. What is likely, however, is that the market will move higher, perhaps substantially so, well before either sentiment or the economy turns up. So if you wait for the Robins, spring will be over. And I can't think of a better way to put it in terms of you can't wait for all the news to be good to buy as an investor, because a lot of that opportunity that existed at that point will be gone.
Yeah. The more market is forward looking, we talk about it all the time. It doesn't really care what happened yesterday. If you've got family member in the hospital and they're in serious condition, you would normally be, very freaked out. You'd run to the hospital. But if they were in critical condition and then they're in serious condition, they're on a path to getting better, your attitude is very different. The market doesn't really care what is happening today or yesterday. It's always looking forward. And that's the message he's sending here. And he was, of course, right.
100%. And the caution, what's going to happen the next month, or he doesn't know. Absolutely true. The market didn't bottom until March 2009, and remember people pointing to that during that period of time, saying Buffett's lost it. He's
Yeah.
wrong. This is going to be the next Great Depression. And you just fast forward a few years, obviously things recovered and then some. And this is a chart I want people to pay special attention to, because when you're in a recession, no one rings a bell telling you it's over. So if you wait for the NBER, who's the official arbiter of recessions in the US, if you wait for them to say it's finally over, at that point you could see here the average return for the S&P 500, it's up already 60%. So clearly we saw this in 2020, right? We had the shortest recession in history. We had that huge decline, and then GDP is recovering after the shutdowns close. But the S&P 500 is up 94% from its low in March, to the point where NBR says they waited until July 2021 to say that recession was over. So definitely don't wait for it. And here's one more. This is one that's in your five mistakes book, Peter. The often what's said during market declines, and we saw this again in 2022, is I can wait. I can wait. What's the harm in waiting in terms of buying when the market's going down? And what does this illustrate to you?
Yeah, I mean, this is the harm, right? Is that the market's very resilient. Every time there's a bear market, I hear clients say, "Oh, my count's down 18%. It's going to take me 2, 3 years to get back to even." But that's not how it works. Whenever that cloud is lifted over the market usually is like a rubber band that's been pulled back. It springs forward very quickly, recaptures all those losses, and then goes on to new highs very, very quickly. So that makes intuitive sense, right? You have a company that's making money, the road is blocked, and then you remove the roadblock. It doesn't like ease its way back to former sales. It tends to leap forward pretty quickly.
Right. And we see this not just during bear markets. We see it all the time. The market now is already back at an all-time high. You and I were talking about that 6% pullback last month. And again, if you if you pause during that period of time,
Hmm.
well, very quickly, as soon all of that concern that people had about that inflation report last month, and the Fed isn't going to be cutting rates sooner, that seems to have disappeared very quickly. Market back at new highs. We'll cover that on the next signal or noise. Number five, have a cash reserve. I'm a big believer in this, and this is a quote from Buffett's 2010 annual letter. Having loads of liquidity lets us sleep well. Moreover, during episodes of financial chaos that occasionally erupt in our economy, we will be equipped both financially and emotionally to play offense while others scramble for survival. And I just love that, especially a point he's making about sleeping well at night. And I know cash. You're not a big believer in cash as being your entire portfolio, because there's going to be a drag. It's going to lag stock. But what is the role of cash for the average investor in the portfolio? Can they apply the same logic that Buffett's applying here, but in a different way, obviously, because you don't want them to be in terms of waiting to buy some individual stock. Their investors are playing a different game, but I think still that concept of having that cash reserve can really serve people well.
Yeah, I mean, I look at an average investor, have 6 months, 3 months, whatever it is that you need that it's sitting in your bank account to get day to day and also to cover you in an emergency if you lost your job or a sudden thing happened. After that, 5 to 7 years of your money in bonds because we need to make sure that no matter what happens in the stock market, your needs can be met, especially if you're retired. Then you look at stocks and private investments. But this is one of the only areas that I disagree with Warren Buffett on because as part of his investment strategy, he will often accumulate cash. So he says often he's not a market timer, but he's got a little bit of market timer in him. And I think this is one of the reasons that he's underperformed the S&P 500 for a long time is, what investors call cash drag. If you've got a bunch of money sitting in cash and the stock market's going up, well, don't be surprised when you underperform the stock market. My guess is if Warren Buffett took his same portfolio but had not sat on cash so much, he probably would at least have matched the S&P 500 over the last decade or two. And I think this is a big part of why he struggled against it recently.
Yeah, for sure. But I would say he's playing a different game, right? His game. If at the end of the day you're a value investor and you don't see value, then just matching the market isn't going to do it for him. He has this discipline, and I know that's morphed over time. He's ended up buying technology companies like Apple, right? It was by far their biggest holding today. But I think by holding cash, he allows himself, he knows that there's going to be another crisis coming, and he, during those periods of time, he wants to have that bandwidth to buy. And if you watch CNBC during any correction, you'll hear people often saying, you'll have a pundit come on and say, we're buying this dip, we're buying this dip. What they don't ask these people is, well, did you raise cash before? Do you have anything dry powder? That it turns out they're already 100% invested.
Right.
So
Yeah.
he is equipped to buy that dip. And you're absolutely right. During a long bull market, he's going to lag. I guess he would argue that the volatility probably is lower because of that. And if he's playing a game to hold these companies forever, he has to get that price point right. But no question, it's been a drag. Where we are today, this is very interesting, Peter. He did deploy some capital in 2022. I think 2020 was just too quick. I mean, he even admitted it. It was
Yeah.
just, not the game he's playing. That 1 month period was just not enough for him to get comfortable doing something. 2022, that bear market lasted a little bit longer. They made some investments there, but if you look at the last year, just continue to build that cash. And now have 182 billion, a record in terms of cash and cash equivalents, and most of that is now in treasury bills. And what he's been quoted as saying, he's very happy to earn 5% while he waits for that opportunity. But again, if you look at this in terms of their overall portfolio, I think their assets are over $1 trillion. So it's less than 20% of their portfolio. And if you're an investor, when you have 10 to 20% in short-term instruments so you can sleep at night, I don't think that's the worst thing. So as an investor, do what helps you sleep at night. And if you enjoy, like some people enjoy, if you enjoy taking advantage of opportunity when it arises, as long as you know yourself and you'll deploy that when it comes, like we know that Buffett will do it. We know that Berkshire will do it because that's within their DNA. Then I would argue, yeah, might call it market timing, but I would say you're not timing it for the next week or the next year, but over, let's say, a 10-year period. If you get that strong opportunity, I think some people it's very few people, but some people like to have that just in case that were to happen, and it will happen given enough time.
Right. Yeah, no doubt. Yeah, it'll be interesting to see what's going to happen in this next phase. He's clearly anticipating something, and it'll be interesting to see how this plays out.
Yeah, and if you looked at a long-term chart of valuations, you could make the case again, equities in the U.S. at least, and that's his preferred areas to invest in the U.S. are still above average in terms of valuations. In 2022, obviously they got better. They took advantage of that. So I think there's another 20-30% pullback. This changes
Yeah, but
significantly.
the valuations, I don't think the valuations are that far off because tech valuations have always been higher than the valuations in other industries. The S&P 500 has become disproportionately tech, not because people just suddenly love to buy tech, but because that's where the most advancements are happening and where the economy is thriving the most. I think if you neutralize for that, it's just not that far off its historical norms, but we'll see.
Yeah, I could debate you on that with some numbers, but it's all depends, like you said. If it's been a paradigm shift and you're giving credit for these tech companies with higher margins continuing to grow, but I would say the composition of the S&P 500 in the last 10 years has changed, but not as much as valuations have changed. So if we look at things like the CAPE ratio, we look at even price to earnings ratio, we're about, if just looking at a standard P, we're about 30% above it. When if you go to 2020 during that correction, we were slightly below the historical average, right? And nothing significant has changed. So we're elevated, but we're not where we were, I'd say, in 2000. And we'll see if it ends up working for them. Again, their biggest holding being Apple. Apple is not a cheap stock anymore. So that kind of goes against their value bias. But in 2008, what a lot of people look at Warren Buffett as this nice guy, right? He's, someone, somewhat your Uncle Warren, essentially, but he can be very shrewd during periods of crisis. In 2008, he did a series of deals with Goldman Sachs, Bank of America, Mars, right, taking advantage of that. And this was an article from, I think, 2013, but saying that they made 10 billion off of the financial crisis. So that's the upside of having some cash when there are periods of of volatility, of crisis, you could take advantage of it. So if you're thinking about your own cash levels, what to do with it, how much you should have, as Peter said, there's no one right answer in terms of an emergency fund. Reach out to us in terms of figuring all that out. Creative planning. We're in all 50 states. Set up a call, set up a meeting. I'll have a link in the show notes. Over 300 billion in assets under management and advisement. And we're here to help. So definitely take advantage of that and look for the link in the show notes. So number 6, be a contrarian at extremes. Be fearful when others are greedy and greedy when others are fearful. This is a quote we hear all the time, Peter. Is this in your nature? Because this is in my nature. But a lot of people get greedy when other people are greedy, and they get fearful when other people are fearful. So we're not, I think most people aren't contrarian by their very nature. How do you react when you see these types of sentiment extremes?
I mean, it's interesting because people are more educated. They know the market's more resilient. They know it comes back. They know all of these things, but the narrative, the drumbeat of the narrative is so much more intense today than in other periods in history, where when you're going through something negative, COVID or whatever, it's coming at you everywhere. I mean, there didn't used to be 24-hour news. There wasn't social media and the internet. I mean, like, it's coming at you from everywhere. So even though people are more educated, it's harder to overcome the fear. And so if you look, it's much worse in terms of the speed with which markets react negatively because of that. I think, like, COVID, quickest 34% drop in history. So I think it's one thing to be educated. It's another thing to minute by minute, month by month, year by year, try to overcome that fear. And I don't think we're going to see an end of this cycle because it's human nature combined with intensity of communication nowadays. In our lifetimes, we're gonna see people do the wrong thing as a group, through the next several bear markets.
Yeah, human nature is still driving things, even though machines are
Mhm.
taking over. And for now, that seems to be the case. And I think before this quote, I think people often reference this quote, but they don't say what he said before this. I think he says essentially, don't market time, but if you're going to market time, this is what you want to be
Yeah.
thinking about, right? And the hard part is obviously quantifying. When are others greedy? When are others fearful? It's not always obvious, as we've talked about on a signal or noise section in the past. You have to really look for extremes, and what I'm showing you here is two separate extremes: extreme fear and extreme greed. In terms of retail investors, they do this poll every week asking investors, are you bullish or bearish? And when the spread is extremely negative, so you have extreme fear where bears outweigh bulls, what you tend to see over the next 3 months to 5 years is above average returns. And when investors are extremely greedy, when you have way more bulls than bears, you tend to see below average returns, and even on average, at least historically, a negative return over the next year. So it matters, but this is looking at the top 3 and bottom 3% of these readings. Most of the time, it's just absolute noise because sentiment hasn't reached that point in time. So keep an eye on sentiment, but most of the time, just ignore it, continue your plan. And like Buffett said, if you're going to market time, there's worse you can do than looking at extremes in terms of fear and greed. Lesson number 7, and this is a strange one that people might find curious because Buffett's known as the best stock picker of all time, Peter. But he often says, when asked what most people should do, he says they should buy index funds. He says here, in my view, for most people, the best thing to do is own the S&P 500 index. People will try and sell you other things because there's more money in it for them if they do. So do you find this interesting that the best stock picker of all time is not advising other people to do the same that thing that he's doing?
Yeah, I find it interesting, like, that he thinks that he can do something no one else on earth can do. And there's a lot of people that have outperformed over the last 10 or 20 years. He's one of the greatest investors of all time. But, what he's talked about historically around this topic is like, look, most of the time when you go into the financial world, you're going to get screwed one way or another because somebody's going to make a commission on something or they're selling their own product or whatever. And so most people would be better off just buying the index. And he uses that in his quotes, like yours right here, most people. And that's 100% true. Most people would be better off just throwing it in the index, and they would probably do better than if they show up in a random advisor's office and just said, here's my money, do with it what you will. Now, if you're educated, like Warren Buffett is, or you're working with an advisor that knows what they're doing, doesn't have commissions on their investments, doesn't have their own proprietary fund, Are you probably going to, be more likely to hit your goals investing in another way? That's what Warren Buffett believes. Of course, that's what we believe too.
Yeah, he feels better. He feels like it's less risky for him to really know a few companies very well and essentially hold them or intend to hold them forever.
Mhm.
Forever. That's his preferred methodology. But I think if you asked him today, and he said, don't expect Berkshire in the future to be what Berkshire's been in the past. And we've already gotten a preview of that, Peter. The last 20 years, Berkshire's trailed the S&P 500. Even coming close to the S&P 500 is an enormous feat, I would say. So this isn't necessarily a loss, but just looking at this here, S&P 500 up 593% over the last 20 years, Berkshire up 572%. Obviously, I would say more risk embedded also in Berkshire, given they're taking a concentration in a fewer number of companies. And then you have the good old Nasdaq 100, right, which is kind of the most ironic thing. And if you can't beat him, join him, which he did join in 2013 and when he started buying Apple. But if you had just bought the Nasdaq 100, you're looking at over 1,000% return. Obviously, that's not likely to be repeated in the next 20 years. But I think this really illustrates how difficult it is, even for the world's best stock picker. And it's not just him there. Obviously, he had Munger until this past year, and he has many great and smart investors there with him. Cash is one part of the problem, but the other part of the problem is you're going to pick losers, obviously, along the way that create a drag as well.
Yeah, I mean, here's one of the greatest investors of all time, whose partner was one of the greatest investors of all time, who employs some of the greatest investors of all time, thinking about this morning, day, and night, don't have other hobbies per their own admission, and over 20 years underperform the market. And I think part of it's the cash we talked about earlier, and part of it's what you said. It's just a very, very hard deal. When you own the S&P 500, you get Nvidia this year, you get Apple a couple of years ago, you get Southwest Airlines a decade ago. You don't get that. If you're picking, you really got to get a lot of things right to be able to beat it. What's interesting though is the overwhelming majority of Warren Buffett's net worth came during this period of time, which shows, even without beating the market, the power of compounding and having time on your side is a big deal. And I think one of the things where Warren Buffett will be in kind of a legend, even 50 years from now, 100 years from now, long after he's gone, is because people will equate his net worth with his investing prowess, when really a big part of it is just he's living a lot longer than everybody else.
Save that. That's coming.
All right. Okay. All right. Sounds good.
Here we go. Take
All
advantage of
right. There we go.
compounding.
All
Lesson
right.
number 8. You don't have to wait long. My life has been a product of compound interest. And here's a crazy stat. Some of you might have heard this before, but this blows my mind every single time. Buffett's net worth today, so he's 93 years old. He's worth 138 billion, and 98% of that came after the age of 65. So he was just a poor fellow when he reached retirement age, just a mere $3 billion in net worth at age 65. And here we are, 93, 138 billion. Now, throw out these numbers, right? People watching this are saying, well, that's ridiculous. I don't have 3 billion. But the math of compounding still applies to you. If you live a long life, hopefully you will, and you let patience and time and compounding do their work, you can have a crazy, crazy result that you wouldn't expect.
Yeah. I mean, I've got a client that was a doctor, and he practiced to age 90, and at age 60 had about 1.5 million, but by 90 had 12 million without saving more money. It was just the
Wow.
money being invested. And says time is the investor's best friend. He's lived a longer life than many, and that's a big part of his equation.
Right. And the fact that he never sells and that
Yes.
he doesn't pay a dividend, right? So all of those gains, which is a very interesting thing. So if we go back to that prior chart here, actually if you look at it, and some people have argued, well, because he doesn't pay that dividend in terms of an after tax return, taxable account, you're actually better off by being in Berkshire Hathaway because all of that money is not being taxed. So interesting side note there. Number 9, integrity is everything. This is my favorite quote on hiring. Somebody once said that in looking for people to hire, you look for 3 qualities: integrity, intelligence, and energy. And if you don't have the first, which is integrity, the other 2 will kill you. you think about it, it's true. If you hire someone without integrity, you really want them to be dumb and lazy. Peter, I know you
I
hire
as
a
someone
lot of
who's
people. Does
employed
this
a lot of
resonate with you?
people, oh my god, it totally resonates. I think it resonates with anybody that's ever hired. I think the whole thing about the world is most people are good and a small group of people are bad, but that group of people can cause an enormous amount of damage. I mean, think about what we go through when we go to the security lines at the airport. I mean, because one in every 600 million people getting on a plane, one person might try to do something. Think of all the time and money and effort and hassle
The
that's
shoe
spent by
bomber.
everybody else.
The shoe bomber ruined it, right?
But
For
yeah, or you think about this small minority of men commit assaults, but yet you have a disproportion of women that have been victims of it because the typical person causes so much damage. There's so many victims. You see this over and over, robbery and so on and so on. It's the same thing in the workplace. When you have one person come in and they're a malignant person, they can cause an enormous amount of damage, especially if as Warren Buffett put it, they're smart and driven. Then the damage is much, much worse. And so part of running an incredible organization is to pull in as much talent as you can. But the other part that's equally as important is what you keep out, right? You could have a bunch of beautiful flowers in the garden, but man, if you've got one poisonous weed, it can really cause a lot of damage. If you make that mistake, I've made that mistake. The next best thing you can do is, pull that weed out as fast as possible. This really resonates with me when Warren Buffett said this.
yeah, hire. I think there's a saying: hire slow and fire fast.
Yeah.
But in terms of integrity, is there any? There's no. Is there any shortcut or trick to figuring that out in advance? Sometimes it's pretty hard, obviously, to decipher who has integrity before you're actually working with them.
I would tell you that a lot of people lie on their resume. I mean, one thing is, if you're an employer out there, definitely check out the resume, ask questions, challenge around those things, see what kind of responses you get. Ask questions you already know the answer to. Do the background check. You'd be surprised what people will tell you. You're never going to nail it, but you can definitely improve your odds.
Yeah, and I'd say and there's often stories about just observing how people treat other people, particularly if
Mhm.
you're going to lunch or going to dinner with this prospective employee and they're treating the waiter or the waitress rudely and they just have a poor attitude about that. That might be a red flag. So don't ignore kind of your gut feeling in terms of these red flags because it's probably meaningful in a way you're probably not thinking about. But you're never going to get it right 100%. But above all else, integrity is what matters in terms of an organization. And gosh, if you look at a place like FTX, right, and things like that, like you probably had 1,000 great people working at that company. It just takes a few people doing the wrong thing for it all
Right.
to go down. Lesson number 10. This is the most important lesson. And as you said, the best advice Warren Buffett gave at this weekend's Berkshire conference had nothing to do with investing, and we'll just listen to Warren's words himself. Okay.
What you should probably ask yourself is that who do you feel that you'd want to start spending the last day of your life with, and then figure out a way to start meeting them or tomorrow, and meet them as often as you can. Because why wait till the last day? And don't bother with the others.
All right, Peter. Any thoughts there?
I just love that stuff. I just love when he says stuff like that, and he's the king of that kind of like common sense thing that makes a lot of people stop and reflect. I loved that. I was, when I posted that on Twitter, I was surprised at the number of people that piled on to how that really kind of moved them or caused them to think about things differently. So it's neat. I mean, it's what makes you love Warren Buffett.
Yeah, and no doubt, 93 years old. That's what you're thinking about, right?
Yeah.
Who to spend time with. Your time is limited. I mean, he talked about in the conference, he doesn't spend as much time nowadays working and thinking about investing in markets, and he's probably thinking about let's spend the time with the people that matters most. So don't wait till you're 93. Do it today.
Yeah.
So we'll end right there. 10 great lessons from Warren Buffett that we can all use in our everyday lives, and we can use them outside investing as well. I want to go to number 2 here, and the concept of selling fear. And you and I, Peter, we're on social media, and we often talk about, well, what would work better? What works in terms of getting engagement and getting views and things like that? And what I always say to you is number one, in terms of what works, is negativity, and particularly selling fear. And that's not just my imagination. They actually quantified this in a recent study here. This was a study where the title was "Negativity Drives Online News Consumption," and we're all familiar with this. The headline has something negative in it, and people are more likely to click in it, and they click on it, and they actually quantified it, saying each additional negative word in that headline increased the click-through rate by 2.3%. But here's even better, Peter. For every positive word in the headline, the click-through rate decreased by 1%. You could see that in the chart here. Positive words, not good for you. Negative words are good for you in terms of engagement. I know you're very positive on social media, often posting a lot of inspiring things. I know you're going to continue to do this, to do it that way, but this is kind of shocking how much we respond to this negativity bias.
Yeah, it's incredible, and I think there's like research around like the beginning of time why we're pre-programmed to operate that way. It's why the political ads are overwhelmingly negative, and why on social media you don't see people bring unifying messages together. It's more really attacking another side to solidify a following, and it's the formula that works. It's unfortunate, and I think it feeds into all the division we see across stuff that's a lot of things not worth arguing about.
Yeah, for sure. And there's a formula you can use, and I don't recommend people doing this, but if they want to increase their engagement, obviously you have to have some content behind it that people like as well. But you just pick these words: wrong, bad, awful, worst, war, right? Sick, fight, scary, hell. Like these are all things
I
that are
love
going
that
to help you
hell
be.
is number 10.
Yeah.
That's
You thought it would be higher on the list?
yeah, I thought it'd be higher than yeah, it sounds pretty negative.
And what you shouldn't be using are things like love and pretty and beautiful. Life is beautiful. Don't say something like that. It'll probably get one like on social
Right.
media. Amazing, funny, awesome. People don't want to hear that, or they're certainly not going to click on it. But in terms of why we do this, it's really wired into us. Like we just weigh negative information more heavily. What they're talking about here is really from evolution standpoint. Like, it was helpful back in the day when you were being chased by a lion to be fearful, and if someone was warning you about that, you took them seriously, and so that gave you time to plan and avoid a potential harmful or painful experience. So it's not unreasonable why we're doing that. It's just it's not the same thing. Obviously, clicking on that negative news story isn't going to help you. It's going to actually hurt you and hurt your psyche. But in terms of the reactions here, people remember that negative comment or that negative headline much more than a positive headline. And specific things like political stuff, as you talked about, and economics, we tend to be even more focused on that negative stuff, probably because we're afraid of financial ruin. We're afraid, obviously, that a politician is going to do something harmful. And you're 100% right. If I'm running a campaign for someone, I'm going to go low because that works. I'm going to be negative and critical because that's what people respond to. But in terms of social media, Peter, you and I see this every single day. There's many different comments like this. So I picked one out because I noticed that you responded to this. You're being a good citizen on X, doing your part, responding to this. Usually I just ignore these things, but here's one. I didn't put the name of the person that tweeted this out because I don't want to give them exposure. I know our viewers are too smart to fall for something like this, but here's a person saying the stock market is due 50% correction. It's going to take the S&P below 2674. Of course, the S&P 500 is above 5,300 today, and they're saying this person's saying tens of millions of households will have their retirement and savings destroyed by being invested in the stock market at these levels. And then he put a question mark. The grammar is terrible, which is a red flag as well. But he's talking about here the yield curve being inverted, which we debunked on a signal or noise. It's not a signal for stock market investing. And he's saying it's only happened 1929, 1974, and 2009. In all those cases, the stock market went down 50%. He's saying after inflation, you're going to lose 75%. But here's the kicker, Peter. Obviously, he's selling this fear to get you to do something. What he wants you to do is invest in real assets. He's running some type of real estate fund, I think, and he puts actually his text number in the tree. Mm-hmm. Somehow, I guess this is allowed, but I did this for my sister, and it changed her life forever. I wish he would put his sister's number there so we could talk to her and interview her. And I know you had this response here, pretty good one, but what is this something that people, unfortunately, that's got a lot of engagement. It got millions of views, and this person has a lot of followers, so it's not just as simple as some random person posting this. Give me your thoughts.
Well, for those just listening and not watching, my response was the stock market's going to go down 50%, and at the same time real estate prices will go up. Precious. I mean, real estate and the stock market are correlated over 80%, as you know. In both cases, you own an asset when you own a business, when you own a property. And this idea that Google and Nike and Apple and McDonald's are going to go down 50%, but that somehow the landlords of the properties around town, their property is going to go up in value. That's just not how it works, right? In the Great Depression, stocks and real estate went down together. In 08, 09, they went down together. During COVID, they went down together. I'm not saying it's impossible. That sometimes we all know sometimes one goes up, the other doesn't. But this was just such a patently false claim by somebody that has a pretty big following in this space. Couldn't resist.
You had to do your part. And for anyone watching this is the type of engagement, though, that actually works. And unfortunately, there will people that call this number. There will people that invest in this. And as you said, they're going to have to learn, unfortunately, the hard way that the two assets move together. Never mind the fact I don't know what type of product he's pushing here, and if it's actually a good thing for investors. We didn't evaluate any of that, but just using this as a tool in order to get people to buy a product, I just think is obviously a shameful way to approach this. And unfortunately, way too many people are preying on people's emotion, preying on their biggest fears, right, in order to get them to do something. And in many cases, it's not going to end very well for that person. And maybe it changed his sister's life, but for most people, it's not going to end very well. So keep that in mind. Keep your emotions in check and respond to positivity. Follow Peter on X for a lot of positive things that you're going to get and a lot of positive messages that you can use in your everyday life. So I want to end, Peter, with signal or noise. We're going to talk about Dr. Copper. This is known as the medal with the PhD in economics. And lo and behold, Dr. Copper is running up substantially. I think it's up over 30% this year. It hit an all-time high this week. And whenever copper's doing something extreme in either direction, either hitting new highs, rallying, or crashing, people say this is a signal of something, either something very good, because there's a demand for copper, means there's going to be demand for industrial goods. It's used in homes. It's used now in electronics and EVs. They say that's a good thing. And when it goes down, they're saying that's evidence of a lack of demand, and therefore stocks won't do well and the economy is headed south. What do you make of Dr. Copper?
So I'm going to let you do your thing here because I'm going to guess it is noise, but I have no idea. So you just go ahead and drop your wisdom.
Okay, you got a good guess there. I mean, that's high probability. We haven't done many things with a signal on here, but Dr. Copper, unfortunately, isn't the signal that people make it out to be. As it turns out, if we look at since 1972, we look at years in which copper is up, years in which copper is down. What you'll notice here, S&P 500 up over 10% in both of those examples. I looked at an annual correlation between the two asset classes around 0.1. So it's not zero. So, but it's essentially meaningless. If you told me copper is going to be up 30% next year, I wouldn't have any way of predicting what the stock market would do based on that fact alone. And here's the more interesting part: the economy, which really is what people put emphasis on. The economy shows almost no change here. You see an annualized GDP growth when copper's down 2.4% per year, 3% per year when copper's up. And if we look at the annual correlation between changes in copper, changes in real GDP, it's actually slightly negative. So a little counterintuitive. And it's not that copper, I would say, never signals a change in demand, right? So a lot of people will talk about, Peter, so they'll go to 2008. You see this huge drop off. It started in July 2008. Copper essentially crashed, right? We had this global recession. Demand crashed. Obviously, demand from emerging markets, a big factor there as well in China. But what people don't remember is the recession actually started in the January of that year, and the stock market actually peaked in October of 2007. So in terms of like a signal for the stock market's a better signal of economic weakness than copper historically. Not that you want to use either one to predict recessions, but it's not always the case that when copper's going down, as we could see here from 2011 to 2015, 2016, it's not always the case that that means that there's an economic slowdown. Copper responds to not just changes in demand, but also changes in supply, right? And so if there's more supply of copper for whatever reason, that might be not necessarily the signal that you think it is. So for all of those reasons, you can look at copper, and it's interesting that it's going up, and maybe it's a sign that economic activity is going up, but more likely it's not really going to be a signal of anything. So you could safely ignore Dr. Copper anytime anyone talks about in terms of predicting what the stock market's going to do and what GDP is going to do. All right, Peter, covered a lot of ground today on Signal or Noise. If you are watching this on YouTube, take a moment, hit that subscribe button, leave a comment. I look at all the comments. I try to reply to as many of them as possible. Hit that like button for more content just like it, and we'll see you next time on Signal or Noise. Thanks for watching.